So after a year of consolidation in the markets, where the returns have been flat for all the major Nifty indices, the valuations have also moderated to some extent. The large caps today are trading near its fair values, while the mid and small caps are about 15 to 20% above its long-term averages. So we believe this market is going to be driven by the corporate earning growth trajectory. Based on our analysis and discussion with several fund managers, the broad-based indices in the large caps could deliver earning growth of 9 to 11%, while in the case of mid and small cap, it could be about 15 to 18% in the next 2-year period. Based on these points, we are primarily making two changes in the portfolio from an approach perspective. The first is in the fund selection approach. In this current market, one needs to be more stock selective than being broad-based index oriented. There are limited stocks and sectors where the valuation and earning growth both are in a favorable situation. Hence, we believe more than the indices, selective stock picking could benefit more from a return perspective. Thereby, we are shifting certain index funds towards the active funds in our high growth index and active strategy. The second change is in the market cap allocation. Currently, our market cap allocation for the last 1 year has been 75 to 80% into the large caps and 20% in the small and mid caps. From a journey perspective now, this has helped us protect the portfolio on the downside and reduce the risk which the mid and small cap has seen during this period. But we believe after a year of flat returns, the valuation which was a major concern for mid and small caps have also come down a bit. With a higher earning growth perspective in the mid and small cap space, plus the several macro push like the lower interest rates and the consumption boost by the government, the mid and small could benefit from here. Thereby, both in our high growth active and index plus active strategy, we are increasing our exposure in the mid and small cap space, both via lump sum and SIP investing, while we'll continue to have the cushion of the large caps to the extent of 55 to 60% in the portfolio. In the month of September, we would be rebalancing your high growth portfolios to bring these changes of increasing active funds and increasing mid and small cap exposures. To just reiterate our thoughts, in such equity markets after a time correction phase, it is a good time to accumulate and continue keeping patience for another 3 to 6 months. Two things how you should be accumulating aggressively. First, increase your SIPs if you haven't done until now, or if you have cash available, deploy it through lump sums whenever you find a dip in the market. We believe the bottom is more or less near, and hence it is a good time to capture the market when it is in its dull phase. I hope you found the video useful in terms of how to plan your investments going forward. If you have any other questions or queries, please do reach out to us. We would be happy answering all of them. Happy investing.